Let's bring on board our guest for today. We have Jitendra Gohil, who is the Director of Global Investment Management at Credit Suisse Wealth Management India, as well as along with Jitendra, we also have Kunal. Very good afternoon to both of you. And Jitendra, let me come to you and get your sense in the markets, given the fact that, yes, we've been seeing this sort of an up move, and it is thankfully being led somewhere by the FIs as well. Do you think now we can say conclusively that the FIs are back in India?
Hi, and thank you for inviting me on your show. See, first of all, the macro improvement in India is pretty stark, and I think looking at the GST numbers, the way rupee has behaved, uh, also the interest rates in India is falling. RBI is infusing liquidity. So, from a macro stability perspective, I think we are in a much better position compared to our peers, and I think that gives some kind of respite to FPIs who was looking at somewhere earnings downgrade, and more or less the earning downgrades have now started to priced in when we were expecting somewhere Nifty growth of 12 to 15%. Now the consensus is expecting somewhere around 9 to 11% kind of a number. So net, I think large part of earning correction is now factored in the numbers, and also the macro stability is helping some sentiment, improvement for FPIs. On the other hand, look at the global factors as well. If you see the de-escalation of the tariff tension, now this is going to be very crucial. How China and US negotiates, but over the past few weeks, we have seen that US has taken a U-turn in terms of putting tariffs on all the countries, and that has led to some kind of sentiment boost. And hence, I think we can't say it's like a FBI will turn extremely positive on India, but at least the selling has abated, and month to date, the FPI flows are also flat to a little bit positive. So I would say it's a great sign, but to see a sustained FPI buying, I think we need to wait a bit until the time we see good recovery in earnings starts to happen.
All right. Hi, good afternoon, Jitendra. This is Shashi also joining in. Great to be speaking with you. But since you are just highlighting the fact that you believe that the selling should stop for a bit, the selling has actually got absorbed. And given the fact that for the earnings that we have seen so far, there hasn't been a big disappointment coming in. Well, of course, there was a disappointment from the IT majors, but on the back of the valuations, the stock were not that hammered. The selling was already done. Give us some sense that what's been your reading in the earnings so far and which were the outliers?
So I think looking at IT sector, I think yes, you are right. We have seen correction happening there, and already market was pricing in. And post the results, we have seen kind of a mixed reaction to IT. I think valuation perspective also the sector has seen good downgrades, and large part of the fear that look we are going to see US recession or major slowdown in the developed economy. I think that's why you are seeing the correction in large part of the IT names. So largely the large caps, I think, looking now attractive. So we have started recommending a few IT names now from a 12 to 18 months perspective. Remember, they are not completely out of the woods. So I think there we see some kind of buying support happening as large part of the negative earnings have started to priced in. Looking at banking sector, I think still there is good headroom. RBI has already infused more than 5 lakh crore of liquidity year to date. So there also, I think the results were a little bit mixed. You have seen some correction happening in the NBFC sectors and some of the private banks as well. And I think there you get good buying opportunity if it corrects another 2 to 3%. So I think as a banking sector as a whole, we remain positive, and we think that earnings recovery is on cards in the banking stocks, given liquidity support and the kind of macro improvement. So net, I think these are the two outlier sectors where we think there could be outsized opportunities to buy. Otherwise, I think consumption is little weak. We have seen some of the retail names reporting, not that exciting numbers. And till the time consumption, broad-based consumption recovery happens, I don't see earnings will pick up in this sector. So avoid, I think, consumption-driven names. I think IT, to some extent, it's a value might emerge over the next few months or so. And banking and financials is looking pretty strong. And barring, let's say, some other sectors such as defense, there we see a lot of traction happening because whatever happening globally as well, in government is also now going to focus more on building their defense, capabilities. Order inflows have started. So I think we are seeing very divergent performance across the sectors, and we need to be cognizant about these all developments happening on the macro front.
All right, Jitendra, but just taking that point forward related to consumption and the spending patterns, help us with your take on the auto counters, because globally, what we are getting to hear from all these global OEMs that they are looking forward to some uncertain times. They do believe that tariff uncertainty could impact the numbers, and they are just lowering their profit guidance and the sales guidance in the times ahead. Do you believe that this could actually trickle into some of the sentiment could actually hit the Indian OEMs as well, given the fact that we have just seen the April auto sales data and they don't look that exciting?
Exactly. So we do not recommend to go for globally exposed auto components companies or to some extent one or two OEMs who are linked to global auto cycle as well. So we are staying away from it. Domestic auto names, there also the valuation is not cheap. So in our model portfolio, in our recommendations, we hardly have any auto sector as auto stocks at this point of time. If you look at even the guidance for FY26, there also we see muted, commentary uh, uh, from the companies. However, some of the auto financiers probably could do well. I think because NBFCs we prefer and we think that is the sector where your lending rates are capped and your borrowing may fall once the interest rate starts to fall further. So net, I think we are a little bit more positive on auto financiers and auto focused, banks compared to OEMs as of now.
Right, so that's your take, especially on the auto OEMs. And I like how, Jitendra, in every answer of yours, banks has made a good feature, prominent feature, even the NBFCs. But then, given the fact that we've already seen such a rapid rise, especially in the banking space, be it in any segment of the banking space, what about the other segment when you talk about the entire financial space? Financialization is a big theme that everyone has been playing, especially when you talk about financialization. You also have the insurance theme that plays, you have the capital market plays as well that comes into all of this. How are you looking at this? And also certain platform companies also that actually benefit with what exactly is happening around them. So are you looking at those segments, or is your pick when you talk about banks and financials is only limited to banks and the NBFCs, which may be having exposure to the auto sector as well?
I think intermediaries who are looking at companies into demat space or dematerialization of securities, and those kind of platform companies we definitely like. But insurance, we are a little bit cautious here. We think that still there is some headroom for valuations to correct. So from overall banking and financial perspective, if I look at our top preference remains for private banks, followed by PSU banks and NBFCs, and to some extent intermediaries in the financial space. But not looking very aggressively on insurance space. There we think competition is going to be increasing going ahead. So I think heightened competition will lead to margin compression there. So we are not very bullish on insurance. It's just like a neutral-ish kind of a view there.
On that note, thank you so much, Jitendra, for joining us. And also, apologies, is a faux pas from my end. Jitendra Gohil is the Chief Investment Strategist at Kotak Alternate Asset Managers. So apologies for that, Jitendra. And thank you so much for joining us today on ET Now.
My pleasure. Thank you.
If you like this video, then like, share and subscribe to ET Now.